Leo here. Let me ask you something real quick. What if I told you that silver, the same metal people trust during inflation, recessions, and market fear, just had one of its quietest crashes in the US market, and most people didn't even notice, because while everyone was busy watching stocks, crypto, and real estate, silver slipped hard, and for some people, that's bad news. But for others, this moment could quietly change their financial future. Now before you think this is just another silver's dead or silver's going to the moon video, stay with me. What I'm about to break down isn't hype. It's real numbers, real history, and real decisions everyday Americans are facing right now. Back in 2011, silver hit nearly $50 an ounce. People thought it would never stop. Fast forward to recent years, and silver has traded mostly between the low 20s and mid 20s. At certain points, it dropped more than 50% from its peak. That's not a dip. That's a crash by definition. So what happened? To understand silver's fall, you have to understand how the US market treats it. Silver isn't just a shiny metal. It's part investment, part industrial tool. Unlike gold, over half of silver demand comes from industry, electronics, solar panels, electric vehicles, medical equipment. When the US economy slows, demand for silver slows with it. In 2022 and 2023, the Federal Reserve raised interest rates at the fastest pace in decades. Higher rates strengthened the US dollar, and historically, when the dollar goes up, silver prices struggle. Investors move money into cash, bonds, and safer yield-based assets instead of metals that don't pay interest. At the same time, inflation started cooling compared to its peak. That removed one of silver's biggest support systems. Fewer people felt the need to hedge with metals. And here's the part most people miss. Large institutional traders reduced their exposure to silver futures. CFTC data showed speculative long positions falling sharply during major drops. When big money steps away, price momentum disappears. So yes, silver didn't just fall, it got ignored. But crashes don't tell the full story. They never do. If silver was truly dead, mining companies would be shutting down left and right. That's not happening. In fact, the average cost to mine an ounce of silver in the US is estimated to be between $18 and $22. When silver trades near those levels, miners feel pressure, supply tightens. And historically, when supply tightens, while demand slowly rebuilds, prices don't stay low forever. Here's another stat that matters. The gold-to-silver ratio. Historically, this ratio averages around 60 to 1. That means it takes about 60 ounces of silver to equal 1 ounce of gold. In recent years, that ratio has been over 80 and even touched 90. Every time it gets that high in history, silver eventually outperforms gold over the following years. Now does that mean silver is about to explode tomorrow? No, and anyone telling you that is selling excitement, not truth. But here's what it does mean for regular people in the US trying to improve their financial situation. Silver crashes create windows, not guarantees, windows. Most Americans don't have access to hedge funds or private deals, but silver is one of the few hard assets you can still buy in small amounts. Physical coins, ETFs, mining stocks, each comes with different risks, but also different advantages. For someone trying to protect purchasing power long-term, silver historically performs well during periods of debt expansion, and the US is deep in debt expansion, over $34 trillion and rising. That doesn't automatically make silver rich-making, but it makes it relevant. Another angle people don't talk about enough is behavior. When assets are boring, ignored, and written off, that's usually when smart positioning happens. When everyone is excited, it's often too late. Now let's talk practical ideas, not theory. If you're living paycheck to paycheck, silver is not a lottery ticket. It's not something you bet rent money on. But for people slowly building savings, silver can act like forced discipline. It's harder to spend a silver coin than cash sitting in a checking account. For investors, silver exposure doesn't mean Ellen. Historically, even a small allocation, 5 to 10%, can reduce portfolio volatility over long periods, especially when stocks correct. And if you're someone who already invests, watching silver can tell you something bigger about the market. Silver often lags before economic slowdowns and leads during early recoveries. It's like a quiet signal most people ignore. Here's the uncomfortable truth though. Silver will test your patience. It moves slow, it fakes people out. It goes sideways for months, sometimes years. That's why most people quit before anything happens. But history rewards patience, not excitement. If you've made it this far, you're already thinking differently than most viewers. That alone matters more than any asset. Because improving your financial situation isn't about finding the perfect investment. It's about understanding cycles, controlling emotions, and making calm decisions when others are distracted. Silver crashing in the US market isn't the end of the story, it's just a chapter. And chapters like this usually separate emotional money from disciplined money. As always, don't blindly follow anyone. Learn, compare, decide what fits your life. If this breakdown helped you see silver from a clearer angle, let me know your thoughts in the comments. I read them. And if you want more honest market discussions without hype or noise, hit the like button and subscribe to the channel. It helps more than you think. This is Leo. I'll see you in the next one.